Stocks, bonds, ETF, crypto, real estate, the investment options are plenty, and that's a problem too. If you could equally divide your money between these investment options and still make profits, that would have been great. But that's not the way how it works. When you randomly invest your money, you risk putting too much money into a riskier investment and losing all of it, or putting too less in an investment that can make you more money. You need to create a balanced portfolio that is personalized based on your financial situation, and that's exactly what we are going to do in the next 10 minutes. A portfolio is nothing other than a collection of your financial assets. A balanced portfolio can reduce your risks and increase your profits. And creating one is very simple. You just need to answer the two fundamental questions, and answering these questions will tell you how you should design your portfolio. And those are what type of assets to buy and how much money to allocate to each asset. I could have finished this video in 1 minute by showing you my portfolio and asking you to invest based on that. But that's probably not going to work for you, because the two main ingredients involved in creating any good portfolio are totally personal. So in this video, I'll tell you what are those two ingredients and how you can use them to create a well-balanced portfolio for you. So do watch till the end. And before we start, you should keep in mind that I'm just sharing my experience here, and this in no way should be considered as financial advice. So let's get started. Peter Lynch, the American investor, once said, "People spend more time and effort to buy the right refrigerator than they do to buy the right investments." The amount of time and effort you are willing to put in largely affects the type of assets you should have in your portfolio. And of course, you have got the option to pay someone to manage your investments for you. But in this case, we are talking about handling your investments yourself. And ideally, based on the time it takes, we can classify investments into 3 levels. If you neither have the time nor the interest, but don't want to be totally left out, then you are in this category. And for those who are here, an automatic investment plan is the best way to go. One which you can set once and then forget. This is where many of us would find ourselves in. We are ready to trade a part of our time and effort to maximize the returns from our investments. Here, we are talking about a few hours in a week to analyze the latest trends in the market and then adjust our investments. And the last category of investors are those who got the time and patience to analyze the markets and time the investments accordingly. Once we identify which level we fall into the time effort category, we can move to the second and the most crucial factor. No investments are risk-free, and anytime you invest money, there is some level of risk involved, and the returns you get from an investment is the price you pay for taking that risk. This is a risk-reward concept. And the key to build the right portfolio is to balance the risk and the rewards. But unfortunately, many of the individual investors do not understand their personal risk level. The first and the most important step in calculating your risk tolerance level is to be aware of your financial goals, be that be saving for retirement, buying a house, or planning a vacation, and use that goal to calculate your investment time frame. That's the amount of time you can keep your money invested. And the longer the time frame, the more risk you can take. If you are at least 20 years of your retirement age, have a reliable source of income and some cash savings, then your risk tolerance level will be high. On the other hand, if you are nearing your retirement age or may lose your source of income, then your risk tolerance level will be low. So let's classify the risk tolerance level into 3 categories: low, moderate, and high, for ease of understanding. Now, take a moment to think about which category you belong to in these 2 factors. How much time and effort you are ready to put in, and what's your risk tolerance level. Because what we are going to talk about now depends on where you stand on these factors. Once we get an idea about what type of investor we are, we can start designing a portfolio around that. So now let's find out what are the investment options available for each type of investor. First, we got low effort and low risk investments. The best investment with the least effort to maintain and lowest risk is a savings account. Though not technically an investment, they still offer you some returns and are completely safe due to account protection. But low interest rates combined with high inflation make it the least attractive option nowadays. If you can afford a bit more risk, a better option would be to invest in ETFs or exchange traded funds. ETFs automatically follow a stock index, thereby requiring 0 effort to maintain. They also bring in much needed diversification for your portfolio across sectors, countries, and markets. If you are not familiar with an ETF, you can check this video where I talk about the investment options in detail. Ideally, you can invest in an ETF such as S&P 500, which tracks the market performance of the 500 largest companies in the US. Here we can use the set and forget model. You set up your account to regularly transfer the desired amount from your bank and then forget about it. low effort, high risk. This is gambling and something I would probably stay away from. My policy have always been never invest in something I don't understand. It would be foolish to invest in high risky assets without taking the time to understand the fundamentals behind them. Now, when we move to the medium effort category, we have more options. If you don't want to take much risk and still want to make better returns than a savings account, buying government bonds would be a good option. Bonds are securities issued by governments to raise money for government programs. You can buy US Treasury bonds from the website based on your investment time frame. They are backed by the US government, and as a result, the risk of losing your money is next to zero. But the returns here are also low compared to other investment options. This is a sweet spot to be in for a young beginner investor. Irrespective of the type of investor you are, it's always a good idea to set aside a part of your portfolio with ETFs, such as the S&P 500. In this case, you can also expand this to include ETFs from developed countries or specific sectors such as renewable energy. By adding some blue chip stocks to the portfolio, you can increase the chance of making profits in the long term. Blue chip stocks are the stocks of companies that are well established like Apple and Amazon. Finally, to add some stability to the investment, you can also allocate a share of your portfolio to bonds. Even though you don't have to adjust your portfolio daily, you have to dedicate some time to analyze the performance of the markets and companies you have invested in. An ideal allocation in this category would be 60% ETFs, 30% stocks, and 10% bonds. Do you remember the risk-reward concept?
Remember, with great power comes great responsibility.
No, that's Spider-Man. This is different. With more risk comes more returns. If you are looking for high growth potential and less concerned about immediate income and risk, then you may want to invest more aggressively in stocks, in particular small cap stocks. Small cap stocks are shares of companies with a total market capitalization between 300 million and 2 billion. They have the potential for high growth rates, making them very attractive investments. However, they are highly volatile and risky investments. In the high risk category, you can also invest in Bitcoin to diversify and bring a share of the crypto market into your portfolio. But keep in mind that crypto markets are highly volatile and speculative, and there is a good chance of losing all your money. A possible allocation strategy in this case would be 35% blue chip stocks, 25% small caps, 20% ETFs, and 10% Bitcoins. The high effort category consists of people who have enough time to analyze the markets daily and adjust the investments accordingly. We are talking about investment bankers, financial advisors, and day traders. We'll have to gather information from news articles, company reports, and then analyze the data in some trading software to make decisions. A day only has 24 hours, and I also got other things to worry about. And I believe most of you are in a similar state. So this high effort category is not for me, and I'm not going to talk about something which I'm not that familiar with. But for those who are interested, you could think of adding some penny stocks or altcoins to your portfolio. If you are made up to this part of the video, that means you are really serious about growing your wealth. Therefore, I would suggest you to check this video where I talk about some of the best stocks, ETFs, and bonds a beginner investor can start with. Finally, no amount of returns can buy you peace of mind. The perfect portfolio is the one which lets you sleep peacefully at night. Relax and enjoy the journey.